Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so let's just dive right in. We're looking at the really precarious situation of BURU Incorporated, ticker BURU. And this company is standing at what you could only call an existential crossroads. It's defined by one hard truth: zero, absolutely zero recognized revenue in the third quarter of 2025. And yet, in the face of that, leadership is forcing this incredibly aggressive transformation into a, quote, defense and security hub. The market's response? Well, it's been brutal. Shares are consistently trading below 20 cents, sitting around 17 cents as of early January 2026, often on these big volume spikes that just scream distress selling.
They really do. And that is precisely the conflict, isn't it? The central question for us is whether this rapid acquisition, roll-up, bringing in Techne, Orbit, Lyocon, can it actually outrun the structural forces of what I see as, well, hyperdilution and some really acute governance risks?
That's the debate. I mean, can the strategy outrun the structure?
Exactly. And look, this is a fascinating microcap case study, but I'm going to argue that the financial structure is the controlling factor here. The attempt to import revenue, it's a strategic gamble, sure, but the foundation it's built on is just toxic. The hyperdilution, the governance red flags, they make the successful execution of this pivot nearly impossible. For any conservative investor, this thing in its current state has to be seen as an avoid.
I appreciate that focus on the financial mechanics. I do. But I'd frame it a bit differently. My position is that the extremity of the predicament, the fact that the legacy industrial laser business is, it's demonstrably dead, that necessitates a radical pivot. The vision of a defense and security hub, strategically, it's sound. It taps into a very real market need for electronic warfare and UAV tech. We're calling this speculative, high risk? Absolutely. But it's one that presents a genuinely attainable path to high reward, if execution is achieved.
But that if is doing a lot of work there. That potential reward is predicated on executing a perfect series of complex, high-risk deals while you're simultaneously just bleeding cash through self-inflicted delusion.
But the bull case, you have to admit, it hinges entirely on closing the primary acquisitions, specifically Techne SPI. Techne is projected to import approximately $50 million in annualized revenue. That one transaction provides the instant P&L validation the company needs to get rid of that going concern threat. And, they're trying to provide the operational counterweight by appointing Dario Barassoni as co-CEO. He's got over 30 years of experience, which is frankly essential for managing something like Techne and the Maddox Defense joint venture. If, and it's the big if, I grant you, if the Techne deal closes and they secure compliance by October 2026, the current, $87 million market cap, it implies this enormous execution premium that could offer significant upside from 17 cents.
That's a compelling narrative for what could happen, but you have to look at the reality of what is happening. The hyperdilution that precedes and just completely undercuts any potential upside. I'm coming at this from a structural perspective. The financial foundation is just fundamentally toxic. The share count has exploded by roughly 1,120%. It went from about 35.5 million shares in November 2023 to 433 million just 2 years later. That level of dilution, it just acts as a permanent systemic cap on any upside. Positive news comes out, and it's almost immediately neutralized.
I see where you cite that share count, but that dilution is a necessity, isn't it? It's to fund survival and the acquisitions. It's not, by itself, a sign of terminal failure and a turnaround. The choice was, instant death from no operating capital or financing this pivot through some really painful dilution.
I'm just not convinced by that, because it ignores the actual mechanism of the financing. It's not just dilution, it's a structural death spiral. The instruments they're using, the convertible notes, the pre-funded warrants, and especially the standby equity purchase agreement, the SEPA, they guarantee the selling pressure continues indefinitely.
Okay, so for our listeners, could you maybe elaborate on how that SEPA functions in this context?
Certainly. The SEPA, it essentially grants the company an on-demand ATM. They can sell new shares into the market to raise cash whenever they need it. When you combine that with convertible notes, you get this vicious cycle. The company needs cash, so they issue warrants or convertible debt. The holders of that debt, they immediately convert it into common stock at a discount and just dump it on the market to lock in their profit. That drives the stock price down, which means the company then has to issue even more shares under the SEPA for the next bit of cash. It's a guaranteed supply of cheap stock, which means guaranteed downward pressure, regardless of Bariziani's vision. That mechanism is what's really in control here.
Well, that is the harsh reality of distressed financing. Yes. But if the Techne acquisition is the pivot point, let's focus on its viability. You brought up cash burn, but what about the regulatory environment? Can this deal even survive the Italian Golden Power approval process for a foreign takeover of a strategic defense asset?
That regulatory hurdle is massive. It's huge, especially for an electronic warfare asset, which is, deemed critical to national security. The risk isn't just a delay, it's that the deal could be blocked entirely. And look at the structure. BURU is lending Techne 13 million euros via a convertible loan. If Italy blocks the deal, BURU is left holding debt to a private Italian company using cash the public entity desperately needs. Remember, they only have about 6 million in cash. That turns a strategic move into a major liability and a cash drain.
I would frame the risk tolerance differently, though. Management is clearly saying, without these acquisitions, we are commercially dead. We see that with the zero revenue in Q3. So, yes, they're acknowledging the Golden Power risk, but securing $50 million in revenue is the singular goal. If they achieve it, it's the only realistic path to mitigating that going concern risk. They're picking a high-risk survival strategy over the certainty of commercial failure.
But survival at what valuation? Let's just look at a peer. Laser Photonics, a direct competitor, generates $7 million in revenue, and it trades at a similar, sometimes lower, market cap than BRU. BRU's $87 million market cap is pricing in a complete success that is just totally divorced from its zero revenue reality. The market isn't buying the strategy, it's just reacting to the mechanical pricing of the hyperdilution. The stock is being valued based on arbitrage, not the business.
That's an interesting point, but I would reframe the valuation as an option on successful execution. Yes, the price is irrational against current revenue, but that's the very definition of a deep turnaround play. Those $5 analyst targets, and yes, they are theoretical, but they represent the massive potential re-rating if that $50 million in revenue shows up, and the company can finally halt the dilution. That would move the price-to-sales ratio back towards something resembling an industry norm.
And that brings us seamlessly from the financial toxicity to, well, who's driving the bus? Who benefits from this dilution? We have to turn to the governance issues, which I find even more alarming than the capital structure. And this leads us right to the acquisition of Orbit SRL, which to me is the most glaring governance red flag of them all.
The company defends that acquisition as strategically critical. What specifically about the terms concerns you beyond the obvious related party issue?
The related party issue is the concern, specifically how the deal was structured financially. Orbit was wholly owned by the executive chairman, Alessandro Zamboni, before this. BURU bought it for $12.5 million, which included $2.4 million net cash advance paid directly to Mr. Zamboni. And remember, at the time of this cash advance, the company's total liquid cash was only about $6 million.
I agree. The optics on that are objectively poor. Using scarce public cash for a direct advance to an insider during a severe liquidity crunch. It's not a good look.
Objectively poor is an understatement. It strongly suggests a transfer of wealth from public shareholders to an insider using capital raised through these highly dilutive deals. I mean, you really have to scrutinize that, even if they say it was reviewed by a special committee. It just fundamentally erodes trust. And this isn't an isolated thing. This is the same chairman who just faced a massive shareholder revolt at Supply at ME Capital, where over half the votes were cast against his reappointment. That history colors everything he does here at BURU.
I appreciate that counterweight on governance. I do. However, the bull case tries to overwhelm that with strategic necessity. The team asserts Orbit,
a SaaS platform, provides the critical nervous system for Techne's hardware. They argue that integration is crucial for modern defense contracts. If Orbit hits its projected $19 million in revenue by 2028, well, the market will readily forgive the conflict. Success would just minimize that perceived conflict of interest.
Forgiveness is not guaranteed, and that involvement leads back to management focus. Can Zamboni really lead this complex turnaround while he's also CEO of a London-listed fintech, SYME, and dealing with the fallout from that shareholder revolt? And on top of that, this dual CEO structure, Zamboni on finance, Barasoni on ops, it seems inherently risky when you need rapid, unified decisions under duress.
I'm not so sure the dual CEO structure is the main risk. I'd argue the rules are bifurcated to mitigate risk. Zamboni is there for the complex financial engineering, the notes, the SEPA, the capital raises you need just to keep the lights on. Barasoni provides the essential operational credibility for the defense side, which is what's crucial for actually integrating Techne and winning contracts. They're trying to cover two massive different needs in a distressed environment.
Well, regardless of intent, the stock's movement right now is dictated by these mechanics, not strategy. And let's address the elephant in the room that traps retail traders, the short squeeze thesis. We have to just forcefully dismantle this myth using the data.
Well, it is important to note the raw nominal short interest is high. It's about 26.5 million shares shorted. That is evidence of significant betting against the equity, and it explains why the volatility is so extreme on any news.
But volatility does not equal squeeze potential. The single most critical metric that undermines this whole thesis is the days to cover, or DTC. It hovers between 1.0 and 1.2 days. Let me clarify what that means. Days to cover is the ultimate trap test. It tells you how long it would take shorts to exit their positions. At 1.0 to 1.2 days, that means liquidity is so high shorts can walk out the door in less than one trading session. There is simply no trap. And that is the psychological and structural prerequisite for a squeeze.
I acknowledge the DTC reality. The constant supply of new shares from the SEPA guarantees liquidity, which prohibits a classic sustained squeeze. However, I would frame the risk differently for traders. Any temporary halt in that share supply, combined with definitive positive news like a golden power approval for Techne, could still generate massive high-volume volatility because of that high nominal short interest. It's an option for high-risk traders betting on binary news flow.
A high-risk auction, sure, but the structural reality is even more sobering. The high percentage of off-exchange short volume, around 60%, strongly suggests mechanical hedging by convertible arbitrageurs. These are sophisticated players. They aren't directional bears betting on failure. They are just locking in financing spreads from the cheap cost to borrow that the SEPA facilitates. This arbitrage acts as a structural wet blanket that mechanically prevents any sustained rally. The dilution machine feeds the short-selling machine, which prevents the stock from recovering. It is, as we said, a vicious cycle.
It is an extremely vicious cycle. And that brings us right back to the binary nature of this. If the execution is perfect, golden power approval comes through, the full $50 million revenue is consolidated, and management secures compliance and stops the financial engineering, the rewards could be multi-bagger. The material shows that. Those $5 analyst targets, however theoretical, they reflect this extreme upside potential that you get from breaking that cycle.
I just disagree on the probability of achieving that level of perfect execution. The company's continued dependence on the standby equity purchase agreement guarantees selling pressure for the foreseeable future. And the severe governance issues, the cash advance, the SYME revolt, they introduce an unquantifiable trust factor that goes beyond any operational projection. The conditions for success are just too numerous and too complex to ignore the high probability of capital collapse and a delisting.
I think we can both agree that BURU Incorporated is not an investment for the faint-hearted.
Indeed. It's a profoundly idiosyncratic risk asset. The material is clear its beta correlation to the S&P 500 is 0.01. Its fate is entirely dependent on closing these highly contingent deals and the credibility of its leadership in handling this dual threat of financial and regulatory complexity.
So the debate, Ultimately, it rests on whether you trust the operational team under Barasoni to execute this pivot quickly enough, or whether you see the financial structure, with its guaranteed dilution and governance red flags, as an unavoidable terminal constraint. The evidence is clear on both sides, and it's complex, leaving the listener to weigh the credibility of the execution against the toxicity of the structure.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.